Welcome to today's explainer. We've got a great one for you today. Now, you likely already know the basics of saving and investing, but right now, we're going to dismantle everything you thought you knew about building real wealth. Seriously, if you've ever wondered why some high earners are just constantly stressed out about money, while others seem to effortlessly grow their net worth year after year, well, you are absolutely in the right place. We are getting right down to the core mechanics of cash flow. Let's get into it. To really wrap our heads around this, I want you to picture something. Imagine two next-door neighbors. They both put in crazy long hours, they both hustle hard, and their dedication finally pays off. Boom. They each just received a massive $20,000 bonus at work. So they both have the exact same amount of cash just sitting there in their checking accounts, and they are both trying to figure out how to spend it before it burns a hole in their pockets. What happens next is literally going to determine their entire financial futures. Okay, let's dive into this. Neighbor 1 takes that 20 grand and heads straight to the dealership. He buys a stunning, brand new luxury car. And sure, his friends are completely blown away, his social media is flooded with likes, but behind the scenes, he just bought himself a massive new monthly bill. Now, Neighbor 2 makes a completely different choice. She takes her $20,000 and buys professional landscaping equipment to launch a side business. Fast forward 5 years. Neighbor 1 is still making car payments, still paying for costly repairs, and covering premium insurance on a vehicle that loses value every single day. Meanwhile, Neighbor 2 used her equipment to earn thousands, she invested the profits, and now she has multiple income streams paying her every single month. See, one bought something that just makes them look wealthy, while the other bought something that actually builds wealth. Section 1. Redefining the rules of wealth, moving beyond things you own. To truly understand why that second neighbor is absolutely thriving 5 years later, we kind of have to completely change our mental framework. We need to throw away the standard dictionary definitions. In traditional accounting, an asset might just be defined as basically anything you own. But if your goal is financial independence, we have to move way beyond that. So here's your new golden rule. An asset is something that puts money into your pocket, increases in value over time, or helps you produce future income. True wealth isn't about hoarding expensive possessions, it's about acquiring tools that actively build your financial future. An asset does the heavy lifting for you. It's not just sitting there gathering dust, it is working. On the flip side, a liability is something that takes money out of your pocket or creates an ongoing financial obligation that you just have to keep paying. The ultimate goal of this entire explainer is to get you to really visualize how money flows in and out of your life. If an asset is a powerful tool that flows money into your pocket, a liability is like an open valve that constantly drains your money out. So let's walk through some of the most common, powerful, wealth-building assets you can actually go out and acquire. First up, we have investments, like stocks or index funds. And what's crazy is some of these pay you dividends, which means a company is literally paying you cash just for waking up and owning their stock. How great is that? Then there's rental property, which can grow in overall value while someone else is paying you monthly rent. Next, a small business. Whether it's a local bakery or a specialized tutoring service, it can continue earning money even when you aren't working every single hour of the day. And finally, digital products, like ebooks, online courses, or software. You put in the hard work to make them exactly once, and they can just keep selling and generating cash for years. And this brilliantly illustrates one of the absolute best, most overlooked assets in existence, your own skills. Imagine you have $2,000 to spend. Option A is spending it on the absolute newest smartphone, even though your old one honestly works perfectly fine. Option B is investing that exact same $2,000 in a skills certification. Maybe learn to code, master video editing, or study accounting. Option A loses value the literal second you walk out of the store. But option B, that new skill could boost your income by $5,000 every single year for the rest of your career. Sometimes the absolute best investment isn't a thing you own, it's what you know. Switching gears for a second, let's look at the ongoing costs of liabilities. We're talking things like monthly payments, interest, repairs, maintenance, and insurance. Now, I want to be incredibly clear here. Liabilities are not inherently bad or evil. You probably need a phone to call your family, right? And you might need a car to commute to work. The goal isn't to live some completely barren life with zero liabilities. The goal is just to clearly understand that these items are guaranteed costs. They are not investments, they are expenses that quietly drain your wealth through all these ongoing obligations. Section 2. The gray area. Context is everything. So if the definitions of assets and liabilities are really that straightforward, why do so many people struggle to build wealth? Well, because the real secret is understanding the tricky everyday purchases that masquerade as assets. In personal finance, the exact same object can be a massive wealth builder for one person and a total wealth destroyer for somebody else. Now, what's really interesting about this slide is that it challenges one of the biggest assumptions we all make. Is your home an asset? Society tells you it absolutely is, but let's apply our new rule. For most people, a primary home actually acts as a liability. Why? Because it constantly drains cash out of your pocket every single month for a mortgage, property taxes, homeowner's insurance, general maintenance, and those lovely unexpected repairs. Yes, it provides shelter, and sure, it might appreciate over a few decades, but on a month-to-month basis, it requires money going out, not money coming in. Let's look at another gray area just to further emphasize that context dictates absolutely everything. Take a vehicle. A personal car is a classic liability. It costs you money for gas, insurance, registration, and it suffers from massive depreciation. But look at a delivery truck. If you own a delivery company and that exact same type of truck earns you $500 a day, it is functioning as a highly effective income-producing asset. The item is physically identical. The difference relies entirely on how it is being used to direct your cash flow. So, you might be wondering, how do we take a traditional liability, like that primary home we just talked about, and force it to become an asset? Well, you can do it through a brilliant strategy called house hacking. Step 1, you buy a home. Step 2, you rent out a portion of it, like a basement unit or a spare bedroom. Step 3, you generate positive cash flow. If the rent you collect covers your mortgage and puts extra cash in your pocket every month, congratulations, you have successfully transformed a liability into a cash-flowing asset. It's a real game changer. Section 3, the ultimate wealth test, your new financial rule of thumb. We've covered a ton of ground today, from landscaping equipment all the way to house hacking. Now we are going to distill everything we've learned into a single, highly actionable rule. You just need to ask yourself this one simple question before any major purchase. Does this purchase bring money in, or does it require more money going out? So the crucial point is that the path to lasting wealth isn't some huge mystery. It is beautifully, wonderfully simple. You just need to consistently buy more assets than liabilities, making your decisions based entirely on this cash flow test. If it brings money in, buy it. If it requires more money going out, be very, very careful. I want to end this explainer with a little bit of homework for you. Don't worry, it's easy. I want you to immediately apply what we just discussed today. Look back at your last 3 major purchases. Be brutally honest with yourself. Were they assets that are actually going to build your financial future, or were they liabilities that are quietly taking your money away? Think deeply about that. Next time, in part 2 of this series, we are going to explore the asset ladder strategy, and we'll look at the most common mistakes that keep people from getting ahead. Until then, take a really hard look at your spending and ask yourself, what is your money actually building? See you next time.